Stephen. I know, listen, you and your clients, they're long-term. You're a big thinker, long-term thinker. The stimulus headlines are moving the markets on a day-to-day basis. How much will they matter long-term? How do we see past this fight?
Look, how the election unfolds and who runs the government will be important to industry composition, which companies can do what in the future, these sorts of things. I think the stimulus itself, in terms of the timing, this is a smaller matter that's not really going to matter to long-term returns. I think we should also remember, just if you take a look, if we care to think about what's going on in markets, not negotiating is itself a tactic. Now, I think we have to look at the post-election result. We have to see who has the stronger hand. Ultimately, if there's a very strong hand for Democrats, it may make more sense for a larger stimulus post-election. But in the past, we've always found some common denominator to improve safety net steps for the public that needs it. And I guess this next couple of months, as COVID is accelerating again in the absence of stimulus, despite the fact that the economy has done remarkably well to adapt since the peak in stimulus in April, this is going to be a risky time. This is going to be a volatile time.
You know what's amazing, Stephen? I know you're not a tech policy analyst, but I will tell you this. You've got members in Congress suggesting that some of these big technology companies may need to be broken up under antitrust laws. I mean, color me an old man, but that should have been the headline. I mean, these are 40% of the entire equity markets that members of Congress are suggesting may need to be broken up, and we're focused on stimulus. To me, the big technology headline is actually what should move the market long term, but maybe it's early and I'm crazy.
Well, look, I think this is a reasonable risk for investors in U.S. stocks to focus in on. When you had one company in Apple that was worth, at its peak recently, more than the entire Russell 2000, more than the entire United Kingdom equity market, and you take a look at TMT stocks in general in the U.S. market, up at 45% of the total market, you might have some concentration risk. Now, again, fundamentally, we think they're doing well. They're going to do particularly well during the next couple quarters when we're COVID bound. They're the way that we are adapting to this particular shock. And in fact, whatever legislation they face, I don't think that their businesses suddenly go away. But this is a concentration risk, and we have to think about other areas of the market which just didn't do so well over this COVID period and have a real opportunity.
Very quickly, Stephen, 20 seconds in the show. Like what? Where do we focus?
Think about, if you care about 2021, think about beaten down real estate. And some examples, people, if they're going to work from home, they're actually going to need homes in some cases. So these are the sorts of things. Think about Latin America and Asia. Think about Europe. Think about being a little bit broader than just U.S. equities.
Shepard Smith here. Thanks for watching CNBC on YouTube.